You walk up to the teller at your bank. You have been banking here for 20 years. They know your name. You have never bounced a check, never missed a payment, never given them a single reason to question your finances. You tell them something completely ordinary. Something you have probably said at a bank counter before without thinking twice. And 3 days later, your account is frozen. Not because of fraud. Not because of a criminal investigation. Not because anyone suspects you of anything illegal. Because what you said, or what you did, matched a pattern that the bank's new automated system flagged as a potential sign of elder financial exploitation. And under laws that took effect across more than 30 states in 2026, your bank now has the legal authority to freeze your account first and investigate later, without advance notice, without a court order, and without your permission. This is not a hypothetical. According to Saving Advice January 2026 investigation into the new banking rules, thousands of American retirees have already discovered this situation in the opening months of 2026. They are losing access to between $3,500 and $10,000 for up to 2 weeks at a time. Not because of anything they did wrong. Because of new laws, new technology, and a banking system that has been legally reconfigured to intervene in senior financial activity in ways that most seniors were never told about. There are 3 specific things that seniors are telling their banks right now. 3 pieces of ordinary information shared casually at the teller window, over the phone, or even through a banking app, that are triggering these freezes. None of them sound alarming. All of them have become dangerous in the current banking environment. Before getting into the 3 specific triggers, you need to understand what changed in 2026, and why this year is categorically different from any banking environment seniors have navigated before. For years, banks were cautious about freezing senior accounts because they faced legal liability for what the law calls wrongful dishonor, the wrongful refusal to process a legitimate transaction. If a bank froze an account incorrectly, they could be sued. That liability acted as a natural check on how aggressively they could intervene in customer transactions. In 2025 and fully in effect across most of the country in 2026, that legal check was removed. More than 30 states have now enacted or significantly strengthened what are called safe harbor laws. According to Saving Advice February 2026 analysis of these laws, they grant financial institutions and individual bank employees legal immunity when they freeze a senior account in good faith based on a suspicion of elder exploitation. The bank does not need proof. They do not need a court order. They do not need to inform you in advance. They need a reasonable belief, as defined by their own internal systems and staff, that something unusual may be happening. The bar for triggering that reasonable belief is lower than most people realize. A teller who notices a customer appears nervous. A transaction amount that is larger than the account's typical activity. A withdrawal to pay someone the bank does not recognize. A phone call happening at the same time as a large transfer through the banking app. Any of these can trigger the freeze, and once it is triggered, the burden of proof shifts entirely to you. Under FINRA Rule 2165 and state safe harbor laws, once a senior account is frozen under the elder financial exploitation provisions, the initial hold can last up to 15 business days. If the investigation is inconclusive, the bank can extend the hold for an additional 30 days after reporting to Adult Protective Services. For a senior living on a fixed income, counting on a Social Security deposit to cover rent, utilities, and prescriptions, a 15 business day freeze is not an inconvenience. It is a financial emergency. The first thing seniors are telling their banks that is triggering freezes in 2026 is also the one that sounds the most innocent. Mentioning that someone else is helping you with a transaction. It does not matter who that person is. An adult child. A trusted neighbor. A financial caregiver you hired. A friend who drove you to the bank. The moment a bank teller, a fraud monitoring system, or a customer service representative identifies that a third party is involved in a senior's financial decision, in any capacity, for any reason, it activates a set of protocols that the bank is now legally obligated to follow. According to Saving Advice August 2025 analysis of account freeze situations, banks are increasingly on alert for elder financial exploitation, and in trying to protect vulnerable customers, institutions frequently go too far. If a teller, fraud team member, or algorithm flags a transaction as suspicious, especially if it involves a senior transferring money to a caregiver, relative, or unfamiliar third party, the bank may freeze the account to investigate. Even if you are fully aware of the transaction and acting willingly, the bank may block it. The AI behavioral systems now running at most major financial institutions are specifically trained to flag combinations that correlate with common elder scam patterns. A senior on the phone while using the banking app, flagged as a tech support scam indicator. A senior accompanied by an unfamiliar person at the teller window, flagged as a potential coercion scenario. A senior requesting a wire transfer to an account the bank does not have on file, flagged as a possible romance scam transaction. None of these situations are inherently suspicious. All of them are triggering holds. The practical implication is direct. If you plan to make a significant transaction, a large withdrawal, a wire transfer, a payment to a new vendor or contractor, do not mention third-party involvement at the teller window unless you have already established the context with the bank. More importantly, if you have an upcoming significant transaction involving anyone other than yourself, call your bank 48 hours in advance and pre-clear the transaction. Explain who is involved and why. Create a documented record in your account file that the upcoming transaction is expected and authorized. A transaction that the bank system already has context for is dramatically less likely to trigger a freeze than one that arrives without explanation. The second thing seniors are telling their banks that is creating immediate problems in 2026 involves account ownership. Specifically, adding a family member as a joint account holder. This is one of the most common estate planning moves that seniors make. An adult child is added to a parent's bank account for convenience, to help manage bills, to ensure access in an emergency, to simplify the eventual transfer of assets. It feels prudent, feels protective. In 2026, under specific circumstances, it has become a serious financial vulnerability. Here is what most seniors and their families do not know when they add a joint owner to an account. A joint account holder is a full legal owner of the account. Every dollar in that account belongs equally to both owners under the law. And the financial obligations of each owner, including judgments, liens, and garnishment orders, can be applied to the joint account. According to Saving Advice February 2026 analysis of bank account freezes, with consumer debt defaults rising, this creates a massive vulnerability for seniors. If the adult child added to the account gets divorced, is sued, defaults on a car loan, or faces any legal financial judgment, creditors can freeze the joint account to satisfy that judgment. Because the child is a legal owner, the entire balance is considered fair game. A senior can wake up to find their Social Security deposit frozen because their son defaulted on a car loan. The bank is legally required to honor the garnishment order, and untangling the senior's money from the child's debt can take months of legal proceedings. The freeze in this situation is not triggered by the bank's elder fraud monitoring. It is triggered by an external legal order that the bank has no discretion to refuse. And unlike the elder fraud freeze, which can sometimes be lifted quickly with documentation, a legal hold stemming from a garnishment order requires a formal legal challenge to resolve. The safer alternative, which achieves the same estate planning goal without the joint ownership vulnerability, is a payable on death designation rather than joint ownership. A payable on death or POD arrangement names a beneficiary who receives the account balance immediately upon the senior's death, bypassing probate and achieving the transfer goal, without that person having any ownership rights, legal claims, or financial liability exposure during the senior's lifetime. The beneficiary has no access to the funds while the senior is alive. Their debts, divorces, and legal judgments cannot touch the account. The senior retains full and exclusive control. The distinction between a joint account and a POD designation is one of the most important and most consistently overlooked details in senior financial planning, and in 2026, with consumer debt defaults rising across the country, the consequences of getting it wrong are arriving faster than they used to. The third thing seniors are telling their banks that is triggering freezes involves a combination of circumstances that most seniors would never think to avoid, because it seems completely harmless. Conducting a banking transaction while on a phone call. In 2026, the AI monitoring systems deployed by most major banks have been trained to recognize specific behavioral patterns that correlate with elder financial scams. One of the most consistently flagged patterns, documented by Saving Advice January 2026 investigation and confirmed by Texas Capital Bank's behavioral fraud analysis, is the combination of an active phone call and a concurrent banking transaction. This pattern is specifically associated with tech support scams, where a fraudster posing as a bank employee, a Social Security representative, Or a technology company calls a senior and coaches them through making a wire transfer while staying on the line to maintain control of the situation. The pattern, phone call plus banking transaction, has become so consistently associated with fraud attempts that AI systems are now automatically flagging it regardless of who is actually on the other end of the call. What this means practically is that a senior calling their adult daughter to let her know they just transferred money to help with a grandchild's tuition, a completely legitimate, completely voluntary transaction, can trigger an automatic hold if the phone call happens during or immediately before the transfer. The AI does not know it is their daughter on the phone. It sees the pattern. It generates the flag. The hold is placed. The same AI systems are monitoring for typing hesitation, the way fingers pause over a keyboard in a pattern that suggests someone is being coached or directed. They are monitoring for login times that fall outside the account holder's established behavioral patterns. They are monitoring for the geographic location of the device used to access the account. A senior who is traveling and logs into their banking app from a location the system does not recognize as part of their established pattern can trigger a security review that delays access to their account while the bank attempts to verify their identity. According to Saving Advice January 2026 analysis, while this technology has successfully identified fraudulent transactions as large as $40,000, it also produces consistent false positives for seniors who are simply learning new digital banking habits or conducting ordinary transactions that happen to match the behavioral signatures the system is programmed to catch. The practical defense against this trigger is behavioral consistency combined with advanced communication. Conduct significant banking transactions from your usual device, at your usual time, from your usual location. If you are traveling, notify the bank before you go and tell them you will be accessing your account from a different location. If you need to make a significant transfer, end the phone call before initiating the transaction. Not because the call itself is suspicious, but because the combination of an active call and a banking transaction is specifically what the system is monitoring for. Here is the larger context behind all three of these situations, and the deeper issue that most banking news coverage does not address plainly enough. The laws and technologies that are creating these freezes were built to address a genuine and serious problem. Elder financial exploitation costs American seniors more than $3 billion annually according to the FBI and the Federal Trade Commission. Romance scams, tech support fraud, grandparent scams, investment fraud targeting retirees. These are real, they are widespread, and they have devastated real families. The banking industry's response, safe harbor laws, AI behavioral monitoring, automatic freeze protocols, is a direct reaction to years of pressure from regulators, advocacy organizations, and legislators who were watching seniors lose their life savings to fraud that banks were not doing enough to stop. The problem is not the intent. The problem is the implementation. Automated systems that cannot distinguish between a grandmother wiring birthday money to a grandchild and a romance scam victim sending their savings overseas are making decisions that affect access to real money in real households on fixed incomes. And the safe harbor laws that protect banks from liability for freezing accounts in good faith mean that the system has no financial incentive to calibrate its false positive rate more carefully. The seniors who are maintaining uninterrupted access to their own money in this environment are not the ones with special bank relationships or particularly simple financial lives. They are the ones who understood that the rules changed, and who adjusted their behavior accordingly. This means pre-clearing significant transactions before they happen. It means establishing a trusted contact on every financial account. Under FINRA Rule 4512, a designated person the bank can call to quickly verify a legitimate transaction, which according to Saving Advice can cut a 15-day freeze down to a 15-minute phone call. It means using payable on death designations rather than joint ownership wherever the goal is estate planning convenience rather than active account management. And it means keeping phone calls and banking transactions separate. None of these adjustments are complicated. None of them require changing banks or restructuring your finances. They require knowing that the banking environment changed in January 2026 in specific ways, and making the specific, small adjustments that keep your money accessible when you need it. The freeze is not a punishment. The bank is not your adversary. But in 2026, the bank is no longer a passive holder of your money. It is an active monitor of your financial behavior, with new legal tools, new AI systems, and new legal immunity to use them. Understanding what triggers those systems is the only way to ensure that protective technology built to keep scammers out does not inadvertently keep you out of your own account. Your money. Your account. Your right to access it when you need it. In 2026, that access is no longer automatic. It is something you have to actively maintain by understanding the rules that changed and by making sure your banking behavior does not accidentally look like something it is not. The 3 things covered in this video are not secrets. They are documented triggers in a new banking environment that most seniors were never told about. Now you know. This video is for educational and informational purposes only and does not constitute financial, legal, or banking advice of any kind. All information is sourced from savingadvice.com January and February 2026 analyses, FINRA Rule 4512 and Rule 2165 official guidance, the FDIC's Senior Financial Protection Resources, and published banking industry analyses current as of 2026. Individual account situations vary. Always contact your financial institution directly for information specific to your accounts. Federal Decoded is not affiliated with any bank, government agency, or financial institution.